Who is this guy? I told you to turn off your camera and your face is still showing. If you don't, you see, if by the time I start this class and your camera is on, I'm going to kick you out of the class. Turn off your camera. Turn off your camera. Arab, turn off your camera. So let's start. So the last class that we did, that was the first class. I'm still going to take the class again because of some people like this again that I'm asking them to turn off their cameras. They don't want to turn off their cameras, and people that kept interrupting the classes. So this time around, please don't know that. That thing should not repeat itself again. So I'm going to start the class again from the first topic, the market structure, the liquidity, and then the point of interest. Also, most people were not in that last class because the limit was at 1000, but I've upgraded the Zoom to allow up to 500 people. That's why I'm taking the class again from the beginning. So as we all know, this strategy is made up of market structure, liquidity, and point of interest. Market structure, liquidity, and point of interest. That's my strategy. When I open up my charts, the first thing I look out for is the market structure. Second thing I look out for is my liquidity, and then the third thing is the point of interest. That's the only three things I pay attention to when I open up my charts. So I'm going to take market structure first, then I'll take liquidity, then I'll take point of interest. I will take one point of interest in this class, that is other blocks. Then in the next class, I will take breaker blocks and other blocks, differentiating between the two of them and knowing when to use the knowing when to use any of them, knowing when to use the other block and knowing when to use the breaker block. So what is market structure? Market structure is the current behavior or condition or the flow of the market. That is what market structure is. The like when market moves from a point to another point, that pattern the market follows to approach that particular point. That is what market structure is. So if for example you are traveling from this place to that place, did you walk in a straight line? Did you walk in a zigzag line? Were you understand that particular structure or the flow of the market to approach that particular point that is going to? That is what market structure is. So market structure is the current conditions, behavior, or flow of the market. So that's what market structure is. Now, there are three types of market movement. Now, so there are two types of market movement. There's the trending market and then there's the ranging market. In the trending market, that's when we have uptrends and then the uptrends and downtrend. And then the ranging market just a consolidation. So There are two types of market movements. There's the trending market and the ranging market. So there are two types of market movements, the trending market and then the ranging market. The trending market, that's when you now have the uptrend and then your downtrend. So for your uptrend is when market is making a series of higher highs and higher lows. It means that for each high that market has, the next high is going to be higher than it. Then the next one that comes up is going to be higher than it. And for each low that comes up, the next one is going to be higher than it. So it's basically market trending up, making a series of higher highs and higher lows. That is something like this. This is what signifies an uptrend. Higher highs and higher lows. Higher highs and higher lows, higher highs and higher lows. So this is what an uptrend is. Then for a downtrend is when market is making a series of lower highs and lower lows. So that's what a downtrend is. So lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. This is what a downtrend is, and this is what an uptrend is. So uptrend, downtrend. And then the third type of market movement is the ranging market. So ranging market looks a bit like this. It's when market moves from one range to another. So it can be from market moving from your support to the resistance, from resistance back to support, from support back to resistance. So this back to here, then from here back to here, from here back to this, then from this back to this. So this is what a ranging market is. It is a consolidation. It means the market is not trending in direction. So a range. So these are the three market movement types: the uptrend, the downtrend, and the range. When market is approaching a particular direction, a particular point, there's always a particular pattern that it follows. It's either in an uptrend or a downtrend or in a range. It moves similar to these three types of market movements. So this is an uptrend, this is a downtrend, and this is a range. So on the chart, you can see an uptrend like this. The chart, this is an uptrend here. Markets making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So this is an uptrend here. This is an example of an uptrend right here. This is an uptrend. Then for a downtrend, this market making a series of lower highs and lower lows, which you can also see from here. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So this is a downtrend right here. So then for consolidation, do I really have a consolidation? Let me check and see if I have market been on a consolidation. That's market being in a range, not really moving from any, that is just from one point to another. That's what a consolidation is. So let me check. Well, it's not really clear, but this is the consolidation right here. I see markets moving from there, here. This is the consolidation from this resistance level down to this support zone, from this resistance level down to this support zone, from this resistance level down to this. So this is what a consolidation is. You can see it's not trending high, neither is it trending low. It's just in a particular fixed range. That is what the consolidation is. That's what a range is. Majority of the time, when there's a consolidation, you start waiting for market to break out to any side, and that's the side they're going to take your trade in that direction. So I mentioned what market structure is. Market structure is the current behavior, condition, and then the current flow of the market. And I said that there are three market movement types. We have the uptrend, we have the downtrend, and we have the ranging market. So that being said, let me now mention the two things I pay attention to when I look at my market structure part of the strategy. There are two things I pay attention to. There is the market structure shift, and then there is the break of structure. So for the structure part of my strategy, for the structure part of the strategy, I pay attention to market structure shifts and break of structure. So market structure shift. So I'll first of all take what market structure shift is. So market structure shift is an indication that the current trend is about to end and the new one is about to begin in the opposite direction. What do I mean by that? When market is on an uptrend, that the behavior of an uptrend is series of higher highs and higher lows. Here you can see this is the higher high. I will signify that with HH, higher high. And this is the higher low. Also with HL. This is the higher high. This is the higher low. This is the higher high. This is the higher low. So what do you notice? Each candle that forms on the high side is always higher than the last one. Higher high, higher lows. Next one that comes is always going to be higher than this previous one. Higher high. Then each low that forms is always going to be higher than the last one. So this is the characteristics of an uptrend. That is what it means for market to be on an uptrend. So what do I mean by a structure shift? A structure shift is when market now deviates from that current characteristics of his trend, now change to the opposite direction. This is what I mean now. You know, the characteristics of an uptrend is higher highs and higher lows. So as you can see, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. The market now does something like this. Maybe does a higher high. Then instead of coming here to now make a higher low to continue the uptrend, it actually goes down and makes a lower low. This is no longer an uptrend because the characteristics of an uptrend is higher highs and higher lows. And since markets came to this particular low and actually broke it to go lower, this is no longer an uptrend, but now a downtrend. Why? Because this is no longer the characteristics of an uptrend. So a structure shift is an indication that the current trend is about to end and the new one is about to begin in the opposite direction. So once there's a market structure shift, the direction that you're taking a trade in before, it changes. So if you are taking buys here, because an uptrend, if you're in an uptrend, you'll be taking buys now, buy continuations. Once there's a market structure shift here, I will signify that with MSS. Once there's a market structure shift here, once that has happened, you're no longer going to be looking for buys in this trade. What you're going to pay attention to is look for sales. Same thing as when market is on a downtrend. You can see the downtrend is series of lower highs and lower lows. So this is a lower high, and then this is a lower low. You now see a lower high, you see a lower low, you see a lower high, you see a lower low, you see a lower high, then a lower low here. So for each high that comes, it's going to be lower than the previous one. You can pay attention. You can see this was the last high. The second high is lower than it. The third high is also lower than the last one. The fourth high is also lower than the last. So that signifies a downtrend. But in a situation where market now does something like this, so you know this is the last lower low here, and the market does something like this. So instead of now continuing this downtrend by making another lower low here and going down, market now does something like this. Breaks this high and makes a higher high. So this is no longer a downtrend. So there was now a market structure shift here. So this particular high that got broken, the market could have made a lower high here, but it made a higher high. This is where your market structure shift is. So in this market, this is now where your market structure shift is. So I'll signify that with MXS as well. So, like I said, whenever there's a market structure shift, you're not going to be looking for trades in the opposite direction. So, the market structure shift is an indication that the current trend is about to end. It's an indication that the current trend is about to end. And the new one is about to begin in the opposite direction. So, for market structure shifts, we're taking a trade in the opposite direction. So if for market structure shift, if the previous trend was an uptrend, once you notice a market structure shift occur, the place you're going to be taking a trade to now, instead of taking a trade on to buys, you're not going to be taking sales. That is what it means by market structure shift. For example, now if you pay attention to this trade, market was on an uptrend. So it was making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs, higher lows, higher highs. The market now came here, broke this low, and started making like once this low got broken, there was a market structure shift. So pay attention now. Once there was a market structure shift in this trade, I'm no longer going to be paying attention to take buys from this particular stuff. What I'm going to be looking for now is sell. So first of all, that is the structure part of your strategy. Now mark out your market structure sheet. That is number one part of the strategy. Now, another thing I pay attention to in the structure part of this strategy is break of structure. Now there are two. I said market structure shift and then break of structure. Market structure shift is an indication that the current trend is about to end and a new one is about to begin in the opposite direction. So in market structure shift, you're taking a trade in the opposite direction. But the difference between it and break of structure is in break of structure, you're still going to be taking a trade that's current direction that market was trending at before. So this is what I mean now. An example of a break of structure. So a break of structure is a scenario where market breaks a particular key level in price while still remaining in its current trend. So let me just type it down. Break of structure is a scenario where price breaks a key level. Right? For example, a resistance or support level while still being in its current trend. So these are the two things that I look out for in the structure part of my strategy: market structure shift and then break of structure. So for market structure shift, I'm looking to take a trade in the opposite direction of the previous trend. But in break of structure, you're going to take a trade in the same direction of that current trend, but it has to break a key level price. So this is what I mean now. I'm giving you an example of a market structure shift. Let me now give you an example of a break of structure. So for break of structure, let's say this is a resistance level in the market. So I'll mark this out as a resistance level. This is a resistance level. And then price was making a series of higher highs and higher lows, which is an uptrend. You see higher highs, you see higher lows. See higher highs, you see higher lows. See higher highs, you see higher lows. Then price is just something like this. So this is a break of structure. Why? Because there was a key level in market that was broken. For example, a resistance level. This is a resistance zone. So as this market was broken, it's still going. So you're still going to be looking for trades in that same direction that market is at currently. A market structure shift breaks structure to the opposite side, or it changes direction to the opposite side. But in break of structure, it breaks structure to that same trend is on currently. So for market structure shift, if market was previously on an uptrend, once it occurs, you start looking for sales. But in break of structure, if market is on an uptrend, once it occurs, you're still going to be looking for buys. Same thing as if this was a support zone right here, and market was on a downtrend, making a series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. And so it does something like this. It has broken this key level, which is a support zone. So now what you're still going to be looking for is still sales, because this was a break of structure and not a market structure shift. If it was a market structure shift, what you'll be looking out for market being on a downtrend and there's a market structure shift, what you now start looking out for is buys. Or since it's a break of structure, market will break a key level, but it will still remain in that current trend it was on before. That's the difference between a break of structure and the market structure shift. These are the two things I pay attention to when I'm looking at my structure part of this strategy. So that is for the structure part of the strategy. I have to go on to the liquidity part of the strategy. So what is my liquidity in this case? What I use as my liquidity is actually inducement. So what I use as my liquidity is actually inducement. So what is an inducement? Inducement is the first valid pullback that market makes after there is a shift in market structure or a break of structure. Let me repeat myself. An inducement an inducement is the first valid pullback that market makes after a market structure shift or a break of structure. Now, what do I mean by this? Once market has triggered a market structure shift or a break of structure, there's going to be a pullback close to where markets either shifted structure from or broke structure from. So in this case, market was on an uptrend, making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs, they now made a lower low. So this is where our market structure shift is. So after the market structure shift, market will now make a pullback towards that direction that it shifted structure from. After making the pullback, it will continue the move. So if the structure shift was to the downside, it will make a pullback to the upside, then continue the move to the downside. So what makes a pullback valid is that it has to cover up at least 50% of the last move, or at least close to where the last move stopped. This is what I mean. Let's say this is a resistance zone now, and market does a break of structure here. After breaking structure, this is now the first pullback it makes. This first pullback has to push markets up close to at least this level before it can come down to trigger the main point of interest and then continue buying. I can either take it close to this level or take it equal to that same level before coming to trigger the main point of interest and then start buying. Or it can take it close to, the pullback can actually take the market above that level before coming to trigger the main point of interest and buying. But whatever you do, you have to make sure that it pushes market close to at least 50% of that last move, even if it's a spike, but at least push market close, just to show that there's momentum in that breakout or in that structure shift. There's momentum there. Sometimes, even if it does not do at least that 50%, it may hold sometimes. But for me, the one I look out for that gives me a strong insight that yes, the people that broke this now to the buying side, the buyer is actually very strong because they were able to push this market up after the first pullback. So that is it. So that is what a valid inducement is, a pullback. The first valid pullback market makes after a break of structure or a market structure shift. An inducement is a trap, it's liquidity. Whenever you see an inducement, markets will come back, strip that inducement, and trigger the main point of interest. So people, that inducement is now inducing early traders to think that okay, market is going to reverse from here. This is where I'm going to start taking my trade from, and they will rush into the trade and eventually get stopped out. And market will still go in their direction, but it will hit their stop loss first. They have been used as liquidity. They were induced early into that trade. That is what inducement is. It's a trap, and that is what I use as my liquidity before my point of interest. So in this case, market was on an uptrend, making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs, then he made a lower low. This was the market structure shift. And I said the inducement in the first pullback after, remember, I did not say before, I said after a market structure shift or a break of structure. So now that there was a market structure shift, we have gotten our market structure shift. So what is the next thing we look out for? Inducement, the one that comes after it. So this was the first pullback, and this is what our inducement is here. Place that the first pullback. So this is our inducement. It can be multiple candles, can be one single candle that just pulls back a bit. Everything depends on time frames. And before you ask, there is no specific time frame I use for analysis. I do multi-time frame analysis. If market is too volatile, I can go down to even 1 minute time frame because that's when I can see the rest of the other consecutive candles. because on the higher time frames, it's just going to be one single candle because market is very volatile. If market is very normal, I can use 15 minutes, 5 minutes, but there's no specific time frame I use. So don't come and start asking me questions about time frames. I do multi time frame analysis. I don't use one single time frame. For the inducement, it can be multiple candles. It does not have to be one single candle. You just have to mark the one that looks cleanest to you, provided that all the rest of them are in the same zone and in the same environment. Was one of the questions that people are going to start asking me now. I've faced it the first time and I don't want to face it again. So the inducement is the first valid pullback market makes after a market shift or break. So this is the one for the market structure for markets breaking structure to the downside. This is the one for markets breaking structure to the upside. So this was this market structure shift. After that, you see markets make a pullback. So this is like the pullback that markets will make. After making that pullback, you push up towards the direction that the shifted structure to. So this right here is our inducement. Right. Let me also mark out the inducement for your break of structure. But this one is for the market structure shift. Here is for break of structure, US. So this should be your inducement. Market to make a first pullback, then continue going in that direction, shift the structure. So this is your inducement right here. So this is your inducement. So the inducement is a trap, like I said. It's what liquidity is. Liquidity is places in the market that has to be swept. Once liquidity is swept on one side, market will head to the other side to sweep the other side liquidity. So if liquidity is taken from this side, market is heading to this side to take out the other side of the liquidity. That is what liquidity is. So the inducement is a trap in the market. Market will eventually come down or come up to sweep that liquidity. By sweeping it, I mean go out and then go below that liquidity zone and trigger the main point of interest or eventually selling or buying. That is what inducement is. It's a trap in the market, a first valid pullback that market makes after a market structure shift or a breaking of structure. So that is my liquidity part of my strategy. Now it's time to go to the point of interest part of my strategy. Now there are 2 points of interest that I make use of the other blocks and I make use of the breaker blocks. I'm just going to take the other block in this class. Then the next class, I will take the other block and then the breaker block. Most times you can see your market structure sheet or your breaker structure. You can see your liquidity and you can see your other block. And then you take a trade from your other block and price does not even get to your other block and it just starts buying because price bought from another point of interest. So knowing what to use your other block and knowing what to use your breaker block is actually very important. That's why there are rules that has been implemented for giving a point of interest. There are 4 rules that has been implemented for giving a point of interest. Well, first of all, let's talk about the other block for this particular class. So I've talked about market structure. I've talked about the 2 things I pay attention to for the market structure part of the strategy, which is my market structure sheet and then my break of structure. And 2 things I pay attention. And I thought about liquidity. I said that my liquidity for this strategy is my inducement. That the inducement is the first valid pullback that market makes after a market structure shift or a break of structure. Now we start to talk about the point of interest part of the strategy. So I make use of 2 points of interest. I make use of the other blocks and the breaker blocks. So other blocks, breaker blocks. So these are my 2 points of interest, my other blocks, and then my breaker blocks slash mitigation blocks. So what is an other block? Another block are those zones in the market where there are a lot of institutional orders. Now, people that trade with $100, $10,000, even $100,000, they really do not make any significant move in the market. There are people that trade with billions of dollars, $500 million, $1 billion. There are people that actually make moves in the market, the market makers, institutional traders. So those places in the market where they place their limit orders, their buy and sell orders, those are what the places that we call order blocks. So we have two types of order blocks. We have the bullish order block and we have the bearish order block. The bullish order block for when you're looking for buys in the market, and then the bearish order block for when you're looking for sells in the market. So for the bullish order block, this is how the bullish order block looks like. You see a bearish candle, and then you see a bullish candle kind of engulf it like this. So this is what a bullish order block looks like. So you see a bearish candle like this. Sorry. Yeah. You see a bearish candle, then you see a bullish one engulf it. Depending on your chart color. So either is blue, red and blue or red and green, but this is how it normally looks like. This is the shape of a bullish order block. And then for a bearish order block, see a bullish candle, then we see a bearish candle engulf it like this. So this is a bearish order block. So bullish order block and then bearish order block. So bullish order block is when you're looking for buys in the market, and then the bearish order block is when you're looking for sells in the market. And normally, for you to take your trade from for the bullish order block, you take your trade from this demarcation right here. If you want to take a sell, take your sell from this demarcation right here. So you just come out and place your, if for sell, you just place your sell order here and put your stop loss just below the validation of that particular candle that you picked your entry from. Then if it's your sell, it's your buy, take your buy from here, the demarcation, and put your stop loss just below. If because of spread, you can put it like 4 pips below or 5 pips below, just to be safe from spread below that candle that you picked your entry from, that other block candle. So this is the bullish order block for taking buys, and then this is the bearish order block for taking sells. So that's just it. So this is how it looks like. And then some people also ask, what about when there are candle wicks, wicks like wicks, candle wicks? How do you pick your entry when there are candle wicks? So this is how you pick your entry when there are candle wicks. So for when there are candle wicks, this is what I mean by candle wicks. This when the other blocks have wicks, how do you pick your entry? For example, if there was a wick here, this, let's say this is the wick here, yeah, something like this, and then this particular one has this kind of wick. This is the candle, then this is the wick. How do you pick your entry for this kind of trade? So pay attention. If the wick of the other block is smaller and shorter than the body of the other block, you pick your entry from the wick. But if the wick of the other block is longer than the body, pick your entry from the body. So this is, for example, this particular other block, the wick is actually shorter than the body of this other block. So if you're picking your entry, you pick your entry from the wick of the other block right here. But in this scenario, this wick of this other block is way longer than the body of this other block. So if you're picking your entry, you pick your entry from the body of this other block right here. So, but in a scenario when there are like three candles, three consecutive candles like this, there are scenarios like this actually. You see one candle like this, you see another one, and then you see a third one this long. If you're picking an entry for this one, just put your entry here. You get here. But I'm just searching for just two candle other blocks. So if the wick of the other block is shorter than the body of the other block, you pick your entry from the wick of the other block. But if the wick of the other block is longer than the body, you pick your entry from the body of the other block right here. So I've talked about my market structure shift. That is the indication that price is about to change direction to the opposite side. Break of structure when there's a key level in market that gets broken. Why market remains in this current trend. I've talked about what my liquidity is. That is my inducement. That is the first value pullback the market makes after a market structure shift or a break of structure. And I've talked about my point of interest. I've said I use other blocks and breaker blocks. I said that another block is a zone in the market where there are a lot of institutional limits orders. And I've said there are two types of order blocks. There's a bullish order block and then there's a bearish order block. Bullish order block for when you're looking for buys, bearish order block for when you're looking for sells. I've talked about how to pick your order blocks. And I talked about how to pick it when there are candle wicks. Now we start to implement charts. So let me go to one set of that. So when I analyzed this setup, this is what I did. So I think I used the 30 minutes time frame for the setup. I used 30 minutes time frame for the setup. So I paid attention to this chart and I noticed that market was previously on an uptrend. So this is the uptrend that market was on before. Here, this was the uptrend. The market was making a series of higher highs and higher lows. So you can see from here, higher highs and higher lows, 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 higher highs. The market now made a lower low right here. So this was where there was a market structure. Remember, I said the market structure, market will change trend to the opposite direction. So this was previously an uptrend, and market changed direction to the downside, meaning that we're no longer looking for buys in this setup, we're now looking for sell. So we have gotten our market structure from this previous uptrend that market was on before. It was making a series of higher highs and higher lows before. It now made a lower low, now changing the direction of this trend from an uptrend to a downtrend. So after I've gotten my structure part of it, what is next I look out for? Remember I said market structure, liquidity, and I said that after I've gotten my structure part, which is the market structure, what is next I look out for? My liquidity. What do I say is my liquidity? Inducement. Now, what is my inducement? The first valid pullback that market makes after a market structure shift or after a structure. So we have gotten the market structure sheet, meaning that the next thing we'll now look out for is our inducement. So the first valid pullback that market makes after that shift is here. So I'll mark it out. And for other people that will say is here, no problem. Mark yours out from here too if you want to. But these candles actually went above these zones. So, and it did not touch my point of interest. So if you want to mark it here, mark it here. I've seen questions from people that I have to cover it here, so they will not come and start asking me that question again. If you want to mark here, no problem, mark here. So mark this as an inducement. But as long as these candles have actually gone above those inducements, I want to mark this as my inducement because it still did not touch my point of interest. So if you want to mark it, no problem. But this is what I marked as my inducement. This is the first valid pullback that market made after the shift in market structure. Because yeah, this one there was a pullback here and they pushed market down. But when market came up here, it actually pushed this market lower than the last one that market pushed this one down to. So I'm using this as my inducement. It is more valid. So this is my inducement right here. So I've gotten my market structure shift. I've gotten my liquidity, which is my inducement. Now it's time to now go for the point of interest. So the one I've taught you guys is the other block. So that was why I set up this trade to be the one that will take with an order block. So I've gotten my market. It's just three things. This strategy is very, very simple. The only thing you're looking at for is just three things. Where is my market structure sheet or my breakout structure? What is my liquidity? That is my inducement. And what is my point of interest? I see my market structure sheet. I see my inducement. Let's now look at point of interest. So now there are two types of order blocks. There is the bullish order blocks and there's the bearish order block. Now, bullish order block for when you're looking for buys, bearish order block for when you're looking for sales. So what are we looking for in this trade? We're looking for sales. So we'll now start looking for the bearish order block. And for you can see, this is what the bearish order block is. So I'll mark this order block as my entry. So this is where I'll be taking my sell position from. And I'll keep my stop loss just above that candle. What happened? The market eventually came, swept this inducement that I said was a trap. Because market people, many people will now be entering this trade from this zone, saying that is the resistance zone. That when market comes here, it bounces back, no problem, bounces back. You take your trade from here. Market will take you out and trigger the other block, the main point of interest, and then sell. This was I think NFP news. And let me see if I have the before of this analysis. And this was the before of the analysis. This was the trade. Higher there was a structure sheet here, inducement, order block. Simple. I didn't even spend up to 5 minutes, and I didn't spend up to 3 minutes analyzing this chart. I just opened up this chart and saw this and marked it out immediately, and I left. It doesn't take once you can spot, you don't have to stay hours looking at the market or looking at the chart. Once you open it and you can see the setup, you will see it. You don't have to force the setup. It presents itself. Once I come to the chart and I look at this and I see this already happening in the market, only thing I have to do is just mark out who my structure shift is, mark out who my inducement is, and then mark out who my point of interest is. Once I've marked it out, I will just set either I wait for market to now trigger it or I set limit entry and I start watching my chart. But it does not take time. You don't have to spend hours saying that you're analyzing a pair. What are you analyzing on the pair? Once your setup that you trade shows itself, you're going to see it and you're going to trade it. Whatever you're now doing on the charts is just you staying there to deceive yourself and force entries on yourself because once you see your setup, you know. So once I come to charts and I see this already, I've already seen what I'm looking at and I'll mark it out and I'll wait for it. So I spent up to 3 minutes analyzing this chart. So this was the before of the analysis, and then this was after. This was NFP news. So it is this particular trade right here. Market structure sheet, inducement, point of interest. So market structure, the point of interest. So for our market structure sheet is what our market structure is. So market structure. This is liquidity, and then point of interest. We can see the three parts of this strategy: market structure, liquidity, point of interest. Just three things. Only three things I have to mark out in charts: market structure, liquidity. So let me see. I have another example. So this for this scenario, this one is a break of structure type of trade. So this is a resistance level here in the market. This is a resistance level in the market. Now I showed an example with market structure shifts. This one is a resistance level. So resistance level, and the market was making a series of higher highs and higher lows. If you pay attention, you can notice it here. It's actually very small ball. Higher highs and higher lows. Higher highs and higher lows. Then higher highs. This was a structure shift and it broke past this resistance level. After it broke past it, it made this first pullback that it made there. A mark here, here. So this my inducement. So this is my inducement right here. So first of all, what I'll mark out is my this this one this one is not market structure. This one is actually break of structure because broke into the direction that it was traveling at before. There was a resistance level here, which is this candle here. This is the resistance here. It was a support that got broken, but now market now broke it, so it's now a resistance level. So this was resistance level. Market was making a series of higher highs and higher lows, higher highs and higher lows, and it broke out from the resistance. So this is a break of structure. After, so this is the structure part of the strategy. So the break of structure now is market structure part of the strategy. So I'll mark that as market structure. So this is the market structure part of the strategy. Then this first pullback that market makes is your inducement. The first valid pullback that market makes after the break of structure, a market structure. So I told you it can be a single candle, it can be multiple candles. In this case, you can see this single candle here, this single candle right here. I don't know if you can see it is very clear. This is the inducement space. So this is your inducement slash your liquidity. So I've gotten my market structure. This inducement is my liquidity. Then I will now look for point of interest. So in this case now, I'll be looking for my order block. Now for the order block, what am I going to be looking out for? Since I'm looking out for buys, the other block I'm going to be looking out for is the bullish order block. And how does the bullish order block look like? You see a bearish candle, you see a bullish candle, engulf it, just like this. Bearish candle, bullish candle, engulf it. So that is what I'm going to be looking out for. So which candles here looks like an order block? This one specifically. So I'll mark this as my entry, and my stop loss will just be below that validation zone here, end of that candle, or I can still add extra piece to it right here just because of spread. And I'll set my buy there. Markets will eventually come, sweep that inducement that is liquidity, then trigger that other block as my point of interest, and then continue buying. So I'll give an example with market structure shifts. I'll give an example with break of structure. I'll give an example with buy. I'll give an example with sell. But that is just the first session for this strategy. Another class, I'll talk about breaker block. Then I'll talk about the 4 rules you pay attention to before picking a point of interest. That will now tell you when to pick your breaker block. And because I think I have a trade here that you'll be waiting for the other block to get triggered. I set up why because it's reacted from the breaker block. And then you that are now waiting for your other block to be triggered, you now miss that trade. So we have that I'll show. Let me look to my telegram. This kind of trade. So you can see your other block down here. Market did not actually buy from this other block. Why? Because they bought from this breaker block. So there are actually rules that tells you, should I take my trade from this other block? Should I take my trade down from this breaker block? There are rules that tells you when to buy from other blocks and when to, when to take your trade off of an other block and when to take your trade off of a breaker block. The next class, I will talk about those rules. I like how I did the class and no interruptions. If and I'm going to start taking questions regarding to what I thought, and please reasonable questions. Last time I was in this class, people were asking me about support and resistance. I don't know the village where you take come from to know that support and resistance is not advanced class. And someone was asking me about top-down analysis that was not even part of what I was teaching in the class. So I'm going to ask questions regarding what I've taught here in this class. So reasonable. So if you have any questions, you can ask. How do I Is the chicken cookie stuff. How many people have questions? I have three. I see three people raising their hands. If you have a question, just raise up your hand. I will see you and then I'll ask you a question. If you have a question, just raise up your okay. Investor DK, Michael, and so Investor DK. Let me ask you to so I've unmute you. Investor DK, unmute yourself so I ask your question. Unmute yourself.
So good evening.
Yeah, good evening.
Yeah. So my question is it possible to have another block above inducement? That is, let's say in a scenario where you're looking for sales and also like have it below inducement in a scenario where you're looking for buys,
I don't really understand your question.
like other blocks. Like
Hmm?
normally, based on how I understand your explanation, other blocks are found mostly above inducement, yeah?
Yeah.
Okay. So is it possible to have them like below inducement?
Yeah, you can have them below. Yeah, taking a scenario of it, you can have them before um, your inducement, but the thing is, it's only valid when that other block trigger the shift in market structure or break of structure. I don't know if you understand. Let me give you a scenario now. Let's say
Okay.
market was on an uptrend, higher highs and higher lows, and higher highs and higher lows, higher highs. Then market now made the structure shift here, and after the structure
Yeah.
shift, there was let's say another block right here, and then you now have the inducement. You can't use this other block here to take your trade because that was not what triggered the shift in market structure. Taking a trade off of the other block that triggered that move that shifted structure or block structure. And I don't think you will have an other block. If any other block you have, provided that it was not after a shift in market structure or after a break of structure, that other block is not the
Mm.
valid one. So the other block you're going to get is the one that is directly after inducement. Like once you see your inducement, you see your other block below it, not above it.
All right. Thank you.
So who was the question? Michael. Michael. Mike.
Like, bro, good evening.
Good evening.
How you doing? I beg you, I want me to go to that this thing. That gold chart where you really explain something. Please can you go back to that chart? I want you to help me clarify something there.
Okay.
Yeah.
This one.
Go back.
This one.
Yeah, this one. Yes, this one. Yeah, this one.
So what's up?
But the other block where they there, I'm thinking it's the thing don't they mitigated already now, but
No, it's not mitigated
look
because the body was not
because
mitigated. Remember the
you see,
rule I said if the week is longer than the body, taking your entry from
mm,
the body of the other block. Don't pay attention to when I said that. So since the week is actually longer than this body or equal than the body, the week is long. So
mm,
for this candle to be mitigated, it has to mitigate the body of
okay,
this
all
other.
this one does not matter. Okay,
Yeah.
okay.
And also mitigation only happens when there's also a structure in like a market structure. You cannot have mitigation before market structure shifts or break of structure. All this mitigation that you're seeing, all these moves here, they are not
Yes.
valid to mitigate the candle because this did not happen after the shift in market structure. It would have only been valid if market does this shift and then comes to mitigate this here. But this ones now happened before the shift in market structure. So it's not mitigation. Mitigation only happens after the shift in market structure or after break of structure, not before it.
And that's what they confuse me. Be saying, and that like say this thing now like this is a downtrend, but
Yeah. No, this was an
but
uptrend actually. This was an uptrend.
you are to sell at this point now. You sold at this point here.
Yeah, so at this
Uh,
point.
now, but the market come be like say make another market structure shifts, can they go up, something like that. And to know the real market structure shift, something like that is
You,
kind
you
of
always pay
complex.
attention to your left side, not what's happening on your right side. You're paying attention to what market is reacting off of. You cannot trade a structure shift here when there's also a structure shift here, and this one has not been reacted to. So you only pay attention to what's happening here from now this side. So whatever
Like
you're trading from here
at
should
this
be
point, at this point now, that is like maybe 3 p.m. If you look there, can you see it?
where
Under that inducements. Yes, at this point, they wrote three. And see the market is going to create higher, something like that now. Higher, low.
this higher high build up. There's the third class, what we call types of liquidity. There's the trend line liquidity, there's the equal high liquidity, equal lows liquidity. This
I
higher highs,
understand.
these higher highs and higher lows that are seeing here now is actually creating liquidity under here for markets to sweep as take profit zones. So this thing now that's
Mm,
happening here now is pushing market to trigger this point of interest, and then it's now
Okay.
creating a bunch of liquidity down here for markets to now. So that's why you see where my TP is
Because most of the time, I
trend
want to take
line.
any trade, and this thing is confusing me at times because I'm not seeing like I'm
No,
not like
just
like seeing that market
pay
and
attention
all
to
that.
your left side. Always pay attention to the left side first. Pay attention to
And
what happened there. Tell you what to trade here. Don't look at here. Now look at this left side. Then this should be for reaction. This should be for analysis. So look at the left side. What's happening here?
mm,
Then this should be for like your take profits and everything. But for here is what you're going to analyze and trading. You understand?
mm, okay, bro. All right, now thanks a lot, my G.
Um.
I'm done. I'm done with
mm,
my question. Thanks, bro.
Andrea, so question. I've sent you a request on mute yourself.
Good evening, bro.
Yeah, good evening.
My question is based on that second example you gave us. Please, I have a question there on the second example, not this one you just explained to this guy.
This one.
Yes, thank you very much. This one, this one.
Okay.
Yes, thank you very much. Please, I want to know, or how is that a valid break of structure, please?
Because this is a resistance zone in the market. This is a resistance actually. You can see. This is a resistance level in the market. Can you see? Can you consider
Okay,
this?
that's
That's this week right here is a resistance level in the market. So this is a significant key level in price. So market broke this significant key level while still remaining in an uptrend. So this is a break of structure. This is a break of structure up here. This week was a break of structure. This candle here is a break of structure. This one is a break of structure. If it breaks here, it's a break of structure. Break this high, it's also a break of structure. You understand? A key level in price. This is a key level in the market. This is a resistance level in the market.
okay. Thank you very much. And how about the inducements? That inducement you say there. I want to know how is that a valid inducement, please? Because
Because
I will use the other one, the one below.
this one, you can use this, but a proper inducement is the first pullback because after market did this breakout structure, this candle actually for this week actually means that price came down here, then now pushed up. Just because you're looking at it on the 15 minutes time frame, and market was very volatile. For there to be a week towards like this downside, it means that price actually came down here and pushed up. That market coming down from this zone is actually a pullback. If you go down to lower time frames, you see that this thing is actually multiple candles. Like I said, depending on the time frame, it is I have multiple candles. It's a higher time frame, you can see one single candle. It's 5 minutes time frame, 3 minutes time frame. You can see multiple candles. As far as this market, which because this was okay, just pay attention to see what I'm saying. It was a break of structure. This week just means that market came down here and then immediately pushed up again on that same time frame. You understand? But it's a pullback.
Okay, thank you very much. That's my question. Thank you. God bless you.
My my conviction. Okay. What's your question? What's your question? I cannot hear you. Like I can't hear you. Victor, Victor, what's your question? Unmute yourself. Victor, send your request to unmute yourself. Yeah, what's your question?
Yeah, can you hear me, bro?
I can hear you. Also, what's your question?
Can you hear me?
I can
Good
hear you.
evening. Okay, so it's about this same example that you gave.
Okay.
So it's about the inducement. Yes, the inducement is the first pullback after the big structure or MSS. But you also said it for it to be valid, it needs to be close to 50% of the break, right? So how is this really valid? Because I'm trying to understand how this is up to 50% of any of the pullbacks.
What I mean is once market breaks out or there's a market structure shift, the pullback has to push market up or down above 50% of the last move. That is what I said. So pay attention. This was the break of
Okay.
structure. Yeah. This
Yeah.
here is the last move. This is where the week stopped. So this is the last move, right?
Okay.
This pullback pushed this thing above here now and still continuing pushing market up. Market actually broke past this last move. It's more than 50%. Pay attention to what I diagram. Said either 50% or equal to 50% or above 50% or more than 100%. It just has to push market close to that zone. This was break of structure. This was the break of structure. This was the last move. Our market will
Yeah.
LA last move. Yeah, this candle that came here pushed market, after pushing markets up now. It even pushed it past the last move to here. More than 100% of it. So it's valid. What I mean by it not being valid is if this was the last move and this was the week and they do something like this and just continues going down from here, that is when it's not valid. But this pushed market way above this thing, to this particular level, before eventually coming down to now trigger the point of interest. So it's valid.
Okay. 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 It makes more sense now.
False iPhone.
All right. Thank you.
False iPhone, what's your question? Omit yourself.
All right. My question here is that if you have a setup, let me say market created a setup below and yet to be triggered, and then it push up, create another setup. Will you ignore the setup it created up and focus on the one below?
I don't understand what you just said. What do you say?
What I'm saying is that if price created a setup, let me say like now, this setup that this example is showed, it created this setup, and yet for it to be triggered, it went up and created same setup up. Like, would you like ignore the setup it created up
You wait for your
I
setup
wait
to
for
trigger.
the one.
You wait for your setup to trigger. You don't trade everything. If you want to take the other one above your your other setup, when you eventually still come on, there are multiple setups and multiple time frames. You don't. There are people you can take your buy from here, and another person can take their buy from here. Another person can also take their buy from here. Another person can take their buy from here. Thing is, the one that is valid is the one you take. The one that you are able to catch is the one you take. Can't analyze the trade here, and this has not triggered. And I'm looking to take another trade from this place. That is indiscipline. So if you're able to catch this market early here, does not trigger, you wait for it. Ignore whatever noise is here and pay attention to the one that you've analyzed. Wait for it to trigger, then you can take it. It's the one that you're able to catch that you take, not trying to catch every move in the market. If this is what you're waiting for, you wait for it to trigger.
Okay, thank you.
Panko. Panko, meet yourself.
All right. Good evening, sir.
Yeah, good evening.
So there was a guy you explained to the previous diagram, not this one, the other one. I'm just about to ask where do we place our stop loss on that trade, but on that particular trade, but
So diagram.
yeah, no, not this one, not this one. The sell diagram, the sell one, the sell.
I said your stop loss should be above those candles that you picked your entry from. Now, for me, I picked my
Exactly, this one, yeah.
I think my stop loss was just here now, above this candle, just slightly above it. That's it. Most people will keep their, if you want to be safe, you want to keep your stop loss, say keep your stop. But I know that when a trade is an order block, market picks entry from the demarcation right here. Better for worse, you may pull in maybe 50% into the order block.
Okay.
But the same time, it does not come to this week and start reacting from it. So I'll just put my stop loss just slightly above that candle that I picked my entry from.
Okay, because I either do the 100% of the order block or the 50%, but
Yeah.
I
But I
normally
don't
do the 100.
I just keep it above that this candle demarcation. That's just it. If I'm taking a sell, keep it above the candle that engulfs. Taking a buy, I'll keep it below the candle that engulfs. So this particular candle in this scenario, keeping it here, just slightly above it.
All right, God blessings. Thank you. God bless.
I'll answer two more questions and then I will send the recordings. Any more questions I have, you just have to come to my DM because I can't answer everybody's question. The other question. Collab collabo. Abi collabo. It's collabo. Unmute yourself, collabo. Unmute yourself.
Okay.
Yeah, what's up?
Good evening, bro.
Yeah, good evening.
Yeah, the last chat you showed the other guy, not this one. I want to say something about that chat. I'm looking at something and
Chat.
it's about this. Yes, can you zoom it, please? The other you told the other guy that this is the first pullback, the one you mark out the inducement. Do you understand?
Yeah.
But what I was looking at this last week here, the last one,
So,
yes, that one, yes. I was looking at that one as my first pullback. Am I
not,
right or
you're not right. It's not the first pullback. This is the first pullback. Technically, to be correct, that's not the first pullback. This is the first pullback. When you realize that you're wrong, is when markets actually cause a mitigation. When you come to breakout blocks and other blocks, and then, for example, now this pullback we're talking about, um, mitigated the breaker, and then you're thinking it's not the first pullback, and you're not picking your entry from the breaker, you hit stop loss because this is actually a first pullback. I've used
okay?
this candle, this is my pullback, and I've gotten my entry multiple times. Let me see if I can get it. I have on my chart on it here. I have a chart on it, so you can know that exactly. So I see this trade now. It's just like this. This candle is just a one single candle, but it's actually a pullback. That was why this at entry, and this was a trade HTP. Yeah, I think I have another one again with the same kind of candle as my inducement. One second. This is this is it. This is a candle wick as my inducement, and then the trade still hit. This is this particular trade. So it's actually your inducement. You have to pay attention. I told you it can be one single candle that pulls back, but it's still the first pullback, and it's very valid to be inducement.
Okay.
So I'll take one more question.
All right. Thank you.
Samsung.
Yeah, good
Yeah,
evening.
yeah, good evening.
Yeah, my question is somehow um actually, and my question is, and I'm very sure a lot of people here they have the same problem. Number one question is that you did the same thing when you wrote the first class when you were mapping the lower low, lower higher high, higher low, higher high. You don't consider how many candles that will, you know, how many candles to make a lower low or a higher high. Like the way we were taught, and let me say me personally, three candles, at least three candles will make a swing, if you understand what I'm trying to say. Three candles, nothing less than three candles will make a swing, which be the maybe higher high or higher low or lower low or lower high. Do you understand? But I can see you just map out like you don't care if it's one candle to the opposite side rather. If the trend is is uptrend, you
Who
don't care
taught
if
you who taught
it's
you that
one
rubbish?
candle to the opposite side.
Who taught you that nonsense? Have you read Candlestick Bible?
That is what
Who taught you that rubbish?
I
There's
learned
no,
from
there's
ICT.
no, there's no from ICT. That's fucking shit. There's no number of candles that can make a higher high and a higher low. You get your higher high
Mm.
when the last swing high is broken. You cannot tell the market how many candles it has to make to consider a
Eh,
high or a low. As long as it's broken. I've sent this candlestick Bible. Observe that candlestick Bible and tell me if there are consecutive amount of candles that makes a higher high or it does not, it's not like that. You cannot tell the candle. Everything what moves the market is volume. If I push in a significant amount of money in the market is going to be very, very volatile. If there's no volume in the market, it's going to be slow. So in that case, will it still be that consecutive amount of candles that will make a high or a low? It does not work like that. What moves is volume in the market. So there's no, where's the last chart? Where's an trend here? There's no amount of candles that can make a high. As long as the last high gets broken, that's a high. The last low, okay, a low. Last high, that is just it. You can even use a line to draw out your trend line without even having to stress about how many candles. By just using a line, you can actually get your trend line. It's really, really that simple. Just come out and mark out your trend line here. It's a trend line. It's don't have to start. See the last high, last low, last high, last low. There's no amount of candles. I'm not even teaching about trend lines here. That this is not a beginner class, something that you read about in Candlestick Bible. So I don't know who taught you that thing, but it's not correct.
that's actually what I still thought. So my second question is that um, if a break of structure does it have to be with a week or a body closure?
A body closure. Has to be a body closure. Market has to close above that zone that is breaking into.
Mm, okay, thank you.
Please, just I'm going to send the recording of this class to the to the Telegram group. So if you have questions regarding to the setup, then if you analyze, I was supposed to take breaker blocks here, but I cannot take because of what happened in the last class. I even saw someone writing that kind of bullshit in this comment section. Well, I had to teach the class because in the first class, more than 100 people could not join because of Zoom. So now there are 170 people in this in the group. So I had to now go and subscribe to Zoom to pro level, but I can have more than 500 people in this info. That was why I had to take this topic again. Most people don't appreciate what you do for them. That's why I have to take this topic because the last class they have more than 100, but now everyone can join. So I will have to take breaker blocks again and then the rules to look out for. I don't know why some people are in a hurry. You are in a hurry to blow your account because you don't want to come down and learn properly before looking to take a trade. I saw someone telling, we already know market structure move. You know, it doesn't mean that other people knows it. So just calm down. If you know you wouldn't be in this class trying to learn. You are here because you want to learn something. So you calm down and learn. If you know the market structure, but not everyone knows it, you have to calm down and learn. Don't be faster than your shadow. So the breaker block will still be taught. For now, anything you want to do, just practice on a demo account, except you have excess funds to be risking your trade. Fine by me. That was how I learned. I was risking my own personal money. So have your journal, watch the recordings I will send to the group, practice on a demo account. If you take a setup on the first regarding with what I've taught you, and ask me questions. So that's going to be the end of today's class.